Hi everyone, Nick here. Welcome back to my channel. I recently got a question in the comments about the Fidelity Zero index funds. The comment made me realize it would be valuable to help you understand the trade-offs between the Fidelity Zero index funds and the more traditional Vanguard or Fidelity index funds. There are some subtle differences and potential hidden costs in the Fidelity Zero funds. Are they actually free, or is there a catch? In this video, we will break this down to help you make a more informed decision when deciding if these funds are a good fit for your portfolio. The most important thing you can do as an investor is to predict the future and go all in on the next autonomous AOL or MySpace coin. Wait, that's not what I meant to say. The most important thing you can do is to understand your investments. You can start by smashing the like button and subscribing to my channel, where I provide free financial education to help you achieve financial independence. The next step is to evaluate the prospectus of these index funds. The prospectus contains the investment strategies, risks, and other details. We're going to use the total US stock market index funds as an example. The ticker for the Fidelity Zero version of this fund is FZROX. Vanguard's ticker is VTSAX. In the section on principal investment strategies, you will notice that FZROX and VTSAX track different benchmark indices. FZROX tracks the Fidelity US Total Investable Market Index, while VTSAX tracks the CRSP US Total Market Index. This is the first difference between these funds. CRSP, the Center for Research and Securities Prices, is an offshoot from the Chicago Booth School of Business. They provide research, data, and benchmark indices to academic institutions and companies around the world. Vanguard uses 16 of their indices for various funds, and the Total Stock Market Index is one of them. Vanguard also licenses indices from other companies for other funds. Instead of licensing an index, Fidelity created their own indices for the Fidelity Zero funds. This is one way they are able to keep the costs lower. I wasn't able to find much data on how Fidelity creates these indices. One thing that is clear is the Fidelity Zero indices contain fewer stocks than the Vanguard funds. FZROX has 2,635 stocks, while VTSAX has 3,781. Does this make much of a difference? Let's briefly look at the equity styles of the indices. Here are the equity styles of the total stock market indices. VTSAX on the left versus FZROX on the right. If you haven't seen my other videos explaining the equity style box, I think it's a great way to quickly compare funds. There are two dimensions. The first is size, with large, medium, and small. This groups companies based on the total amount of money invested in the company. The other dimension is the breakdown of growth versus value, or a blend of the two. A growth company is one that is expected to grow a lot, like Tesla. Value companies are more stable, boring companies like Verizon or Comcast. For the total market index fund, the equity styles are almost identical between the Fidelity and Vanguard funds. Vanguard has a couple percent more in large growth. Next are the international stock indices, VTIAX on the left and FZILX on the right. This one has more of a difference, with the Vanguard fund having more medium and small companies than Fidelity. 75% of VTIAX is in large companies versus 84% for FZILX. This is pretty significant. The breakdown of value versus growth is almost identical, with 1% more in growth for VTIAX and 1% more in blend for FZILX. Next are the large cap index funds. Vanguard licenses the S&P 500 index. We have VFIAX on the left and FNILX on the right. VFIAX has 2% more in value, while FNILX has 2% more in growth. FNILX has 1% more in medium companies. This isn't a drastic difference overall. Next are the extended market index funds. These have the most significant difference. I made another video on the extended market index funds, which I'll link below. But they are basically meant to be used with the large cap index fund to match the total market index fund. My other video explains why some people do this. We have VEXAX on the left and FZIPX on the right. VEXAX has 12% in large versus 0% for FZIPX. VEXAX has more growth while FZIPX has more value. This is where the astute viewer left a comment asking about why the Fidelity Zero Extended Market Index is so different from Vanguard's. It's a pretty significant difference for funds intended to track a similar benchmark. There are likely other minor differences in the industry breakdowns and even country breakdowns for the international fund. You can look at the data yourself. The main point here is that the benchmarks are different. With Fidelity, they are using a new proprietary index. Who knows how good they are at constructing their own index and what their priorities are? There could be a conflict of interest to make more money or to take on a little extra risk so they can advertise better performance. This could result in subtle differences in the index and their performance. Fidelity doesn't have as much history as the proven CRSP, FTSE, or other indices used in Vanguard or the more traditional Fidelity index funds that have an expense ratio. So does this matter to you in your portfolio? By diligently investing month after month, you will most likely become a millionaire with any of these index funds. However, it's possible the performance could have a fairly significant divergence over a period of 40 years. This is a risk you have to take when selecting an index to track. It may do slightly better or worse than another similar index. Let's say you invested $1 million in the Fidelity Zero indices when they launched, split with 60% total US market and 40% total international market. This is roughly how I invest in my portfolio. At Vanguard, you could do this with the mutual funds with a weighted expense ratio of 0.068%. If you use the ETF share class instead, which are the same funds, but as ETFs, you could lower it to 0.05%. So how much is that? For the $1 million portfolio, you would pay $680 per year in expenses for the mutual funds and $500 per year for the ETFs. This is a reasonable amount of money you could possibly save with the Fidelity Zero indices. However, we saw that indices aren't exactly the same. Let's use Portfolio Visualizer to backtest this $1 million portfolio in the Vanguard versus Fidelity Zero funds. Since September 2018, we can see the performance was nearly identical, but the Vanguard portfolio outperformed the Fidelity Zero by about $5,000. This already accounts for the extra expenses you would have paid Vanguard. If you're using the Vanguard ETFs, the difference was about $5,500. Imagine compounding this difference over decades instead of just 2 years. Past performance doesn't predict the future, but so far it doesn't look like you would have actually saved anything with the Fidelity Zero funds. It's possible the Fidelity Zero funds beat the more established indices in the future. there are a couple other important factors to consider. Fidelity Zero funds can only be purchased and held at Fidelity. With Vanguard mutual funds, you can convert them to the ETF share class. This gives you more portability. You can use any broker you wish. You can also take advantage of broker transfer bonuses. Some people do this to generate a couple $1,000s per year in bonuses. For instance, M1 Finance is currently offering a $2,500 bonus if you transfer $1 million in assets to them and keep it there for a few months. This is a bit of a hassle, but is something you can do with the Vanguard ETFs, which you cannot do with the Fidelity Zero funds. This brings us to the next advantage of Vanguard having ETFs. Vanguard has a patent on a way they combine ETFs and mutual funds. What this does is it allows their mutual funds to have the same tax advantages as ETFs. This allows Vanguard to avoid paying capital gains to mutual fund and ETF investors. Other companies like Fidelity don't have this advantage and have had to pay some capital gains to investors. In 2018, the first year of the Fidelity Zero funds, FZROX paid a short and long-term capital gain distribution. If you had $600,000 in FZROX from our sample portfolio, you would have realized a short-term capital gain of roughly $532 and a long-term capital gain of about $133 for 2018. You would owe taxes on these gains, which would have made these further underperform the Vanguard funds. In 2019, this fund distributed a long-term capital gain and didn't distribute any capital gains in 2020. It has gotten better since year one, but this could change in the future. Vanguard still has a patent that gives them an advantage from a tax perspective. Another minor benefit of the Vanguard funds is they pay quarterly dividends, while the Fidelity Zero funds pay a yearly dividend. This isn't a huge difference, but I prefer the more regular dividends. Now we've compared the main differences between the funds themselves, their benchmarks, their fees, the performance, the portability, and tax efficiency. In my opinion, the Vanguard funds are the clear winner. The only advantage I see with Fidelity is there is no minimum investment, while the Vanguard funds have a $3,000 minimum. However, the Vanguard ETFs require a minimum purchase of 1 share, which is close to no minimum. In addition to the funds and ETFs at Vanguard, I personally favor Vanguard as a company. Vanguard was created as a nonprofit company owned by its investors. This means that you buy a Vanguard fund, you are a partial owner of Vanguard. Vanguard was founded by John Bogle to give investors a fair shake. Obscene fees like 1 or 2% yearly expense ratios were very common. For a $1 million portfolio, a 1% expense ratio would be $10,000 per year in fees compared to the $500 to $680 at Vanguard. That's money the fund managers make instead of you. Vanguard has been driving investor costs down since it was founded in 1976. To contrast with Fidelity, Fidelity is a private company owned by a billionaire. Did they innovate and offer investors index funds 40 years ago? In my opinion, Fidelity has been forced to compete with Vanguard and launch products like the Fidelity Zero funds to attract customers. I believe they are doing this to try and establish a relationship with investors and make some money from them and other services. Don't get me wrong, I still think Fidelity is a fine company. I have more than $250,000 invested in Fidelity index funds. Not the Zero funds, but the ones tracking more proven benchmarks. Fidelity has great index funds and provides good customer service. I don't think the Fidelity Zero funds are worth it, and given the option, I would choose Vanguard over Fidelity. Thanks for watching, everyone. Let me know what you think of the Fidelity Zero funds in the comments below. I hope you got value from this detailed breakdown of how to compare these funds. If you enjoy this type of content, please remember to like the video and subscribe. It helps share this free financial education with more people. Later.